Have you ever opened your mailbox and felt your stomach drop before you even read a single word? Because you already know what it is. It's not a birthday card, it's not a refund check, it's not good news. It's that letter with the polite tone that basically says, "Congratulations, you're paying more now. Your auto insurance, your home insurance, your health insurance." And they always write it like it's the weather, due to market conditions. As a result of rising costs, we're adjusting your premium, like your bill just wandered up on its own, like it's a natural phenomenon, like rain. But here's what really messes with my head. Most people in America are paying more for insurance than they ever have, and somehow they've never felt less insured. You do the responsible thing, you pay every month, you stay covered, and then the moment you actually need to use it, your car, your house, your health, you discover there's a trapdoor under the floorboards, a deductible you forgot about, a network you didn't realize mattered, a claim that suddenly turns into a negotiation, a covered event that's covered until it's not. And that's the insurance trap nobody talks about. Not that insurance exists, not that you need it, but the system that makes you feel protected while quietly making you pay like you're not. My name is Papa. I spend way too much time thinking about money, incentives, and why normal people get financially ambushed by responsible decisions. So if you've ever felt like insurance is turning into a second rent payment, hit subscribe. Because once you see how this machine actually works, you will never look at a low monthly premium the same way again. Now, before we get into the tricks, loan term style tricks, but for insurance, we need to start with the numbers, because the numbers are where the trap becomes impossible to unsee. All right, the numbers. Because once you hear these out loud, you stop thinking, wow, insurance is getting pricey, and you start thinking, wait, how is this sustainable? Let's start with auto insurance. The National Association of Insurance Commissioners reported that the countrywide combined average premium for personal auto insurance rose to $1,438 in 2023, and the combined average premium increased 14.41% in that single year. 14% in 1 year. That's not a little adjustment. That's a rent increase level jump, except it follows you everywhere you drive. Now homeowners insurance. Freddie Mac estimates that by 2023, the average borrower was paying about $1,522 per year, which was 10.8% higher than 2022 and more than 40% higher than 2018. So if you're a homeowner, you're not imagining it. This isn't just creeping up, it's climbing. And then we get to health insurance, which is where the whole thing turns into a magic trick. KFF's 2025 Employer Health Benefits Survey found the average annual premium is $9,325 for single coverage and $26,993 for family coverage. And people always hear that and go, yeah, but my employer pays most of it. Okay, workers still contributed on average $1,440 for single coverage and $6,850 for family coverage. And that's just the premium, because even after you pay the premium, a lot of people still have a deductible. KFF also found the average deductible for single coverage is $1,886 for workers in plans with a general annual deductible, meaning you can pay every month and still have to pay almost $2,000 before the insurance starts acting like insurance. And if you're on a marketplace plan, the out-of-pocket limit can be brutal. For the 2025 plan year, it can't be more than $9,200 for an individual and $18,400 for a family. And for 2026, it jumps to $10,600 and $21,200. So when someone says, I'm insured, what they often mean is, I'm paying a lot to still be on the hook for a lot. And that's the moment you realize the trap isn't that insurance is expensive, it's that the system is designed to make you focus on one comforting number, your monthly premium, while the real price tag is hiding behind the fine print. Now that you've heard the numbers, here's how the insurance trap actually works, because it's not just things are getting expensive. It's the way the system quietly moves more and more of the risk back onto you while still collecting that monthly premium like clockwork. The premium is the number that feels manageable, so it's the number you anchor on. But the real cost of insurance is premiums plus deductibles plus coinsurance plus exclusions plus time plus stress. And the most invisible weapon in that whole setup is what I call deductible creep. KFF found that for workers who have a general annual deductible, the average deductible for single coverage is $1,886 in 2025, meaning a huge chunk of people are basically paying a monthly membership fee for the privilege of paying almost $2,000 before the plan starts acting like insurance. And if you're buying a plan on the marketplace, the out-of-pocket limit for the 2025 plan year can't be more than $9,200 for an individual and $18,400 for a family. For 2026, it rises to $10,600 and $21,200. So you can do everything right, pay every month, stay covered, be responsible, and still get hit with a five-figure year if the wrong thing happens at the wrong time. That's why people feel like they're paying more and getting less. Insurance didn't stop being insurance, it just evolved into something colder. You're not buying full protection, you're buying a ceiling. You're buying the right to negotiate after something bad happens. And the way they sell it makes you think you bought peace of mind when what you really bought is a stack of rules that decides whether you're allowed to feel safe. Now let's talk about how this exact same trick shows up in auto insurance, because the phrase full coverage is about to sound like a joke. Now let's talk about auto insurance, because this is where the trap looks the most normal. You pay every month, you assume you're being responsible, and you tell yourself, at least I'm covered. But what does covered even mean anymore? The NAIC says the countrywide combined average premium for personal auto insurance rose to $1,438 in 2023, up 14.41% in a single year. And when your bill jumps like that, most people do what the system quietly encourages them to do. They start shopping for the most comforting number on the page, the monthly premium. And the easiest way to make that number feel better is to slide the risk back onto you. Raise the deductible, lower the coverage, trim the extras. Suddenly your premium looks manageable, but your protection just got thinner. This is why full coverage is such a dangerous phrase. Full coverage isn't a legal definition, it's a vibe. You can have full coverage and still get punched in the face financially because your deductible is $1,000 or $2,000, your limits don't match your real exposure, or you assume something was included that absolutely is not, like rental reimbursement when your car's in the shop. And then there's the moment that turns this from annoying to catastrophic, the claim. Because insurance doesn't feel like protection when it becomes a negotiation, you learn very quickly that you didn't buy a magic shield, you bought a contract, and the contract is written in a language that basically says, we'll pay if the situation fits inside this box under these conditions, with this paperwork, on this timeline. So the trap isn't that people don't have insurance, the trap is that people are paying more than ever, and still one bad accident away from realizing what they actually purchased. And once you understand that, homeowners insurance starts to look even scarier, because with your house, the numbers are bigger, the risks are bigger, and the coverage gaps are way more expensive. Now let's talk about homeowners insurance, because this is where the trap gets mean. With auto insurance, you're arguing over a car. With homeowners insurance, you're arguing over the thing that's supposed to be your safe asset. Freddie Mac estimated that by 2023, the average borrower was paying about $1,522 per year, which was 10.8% higher than 2022 and 40.8% higher than 2018. So people see that jump and they do the same thing they do with every other bill. They optimize the monthly number, they raise the deductible, they trim coverage, they assume they're still fine, a T, because they still have a policy. But homeowners insurance has a brutal secret. Having a policy and being fully protected are not the same thing. First, there are major disasters people assume are included that often aren't. Flood damage is one of the biggest examples. Standard homeowners coverage typically does not cover flooding, and flood coverage is usually a separate policy. Earthquakes are another one. Standard homeowners coverage generally does not include earthquake damage, and earthquake insurance often comes with a percentage deductible, commonly in the range of 2% to 20% of the insured value, meaning your deductible could be tens of thousands of dollars on a typical home. Then there's the reimbursement trap, actual cash value versus replacement cost. NAICC explains that actual cash value factors in depreciation, which can mean you get paid something but not enough to fully replace what you lost, so you feel insured right up until you realize the check won't rebuild your life. And finally, the big picture squeeze. In areas with higher climate-related risk, premiums can rise sharply and some insurers reduce exposure or leave markets altogether, which makes even staying insured harder over time. The result is the same pattern we've been building this whole video around. Premiums rise, people buy less protection to keep the monthly number tolerable, and they don't discover the gap until the exact moment they need the coverage to be real. Now, here's the part that makes this whole thing feel like a scam even when it's technically working. When premiums go up, most people don't suddenly get richer to match them, they adapt. And the way they adapt is exactly how the trap gets deeper. They raise deductibles to make the monthly number feel tolerable. They drop coverage they hope they won't need. They pay monthly and treat insurance like a subscription because the premium becomes the fixed payment that the whole budget revolves around. And then when something actually happens, the other costs get shoved onto credit cards. Co-pays, prescriptions, repairs, a rental car, temporary housing. So insurance becomes this weird two-layer system where you're paying every month for peace of mind, but you're financing the actual consequences with revolving debt. And this is why people say, I have insurance, but they still avoid going to the doctor, still panic about claims, still feel one bad week away from getting crushed. Because look at health insurance alone. In 2025, the average annual premium for family coverage is $26,993, and the average worker contribution is $6,850, and that's just to stay enrolled. Even after you pay the premium, many plans still come with a deductible. The average deductible for a single coverage in plans that have a general annual deductible is $1,886. So you can pay all year and still be paying again before the plan starts acting like protection. And if you're on an individual marketplace-style plan, the out-of-pocket limit for 2026 can be as high as $10,600 for an individual and $21,200 for a family. That's the trapdoor. That's the moment people realize insurance isn't a shield, it's a contract with a cover charge. And zoom out one more step. The estimated total annual cost of healthcare for a typical employer-sponsored plan family of four is $35,119 in 2025. $35,000 a year flowing through a system, and you still have to wonder every single time, will they actually cover this? So the insurance trap isn't that you're uninsured, it's that you can be fully insured and still not be financially safe, because modern insurance sells you the feeling of security on the front end, and then on the back end, it turns security into paperwork, rules, and thresholds. My name is Papa, and if you remember nothing else from this video, remember this. The monthly premium is not the price of insurance. It's the entry fee. The real price is what you discover only after something goes wrong. And the next time you open that envelope that says your premium is going up because of market conditions, you'll finally understand what they're really saying. You're paying more, and the trap is getting deeper. And before someone comments, okay, Papa, so what am I supposed to do, just cancel everything and pray? No, that's not the point. The point is to stop buying insurance like it's a vibe and start buying it like it's a contract. Because the trap works when you treat the premium as the price. The premium is not the price, it's the entry fee. So here's the move. Stop asking, what's the monthly, and start asking, what's the worst case year? What's the deductible? What's the out-of-pocket max? What happens if the claim is denied and you have to appeal? What happens if your car is totaled and you need a rental for 2 weeks? What happens if your house needs repairs that aren't covered because the policy says it was maintenance and not damage? That's not pessimism, that's adulthood. And if your plan has a high deductible, then your emergency fund isn't optional, it's literally part of the insurance plan. The deductible is your portion of the deal, whether you like it or not. So treat it like a bill that hasn't happened yet. Build a buffer that matches reality, not vibes. And then, do one last thing that feels boring but saves people from financial faceplants. Read the parts you're avoiding, the exclusions, the limits, the rules that decide whether covered means covered. Because the worst day to learn your policy is not when you're calm with a cup of coffee. It's when you're stressed, hurt, exhausted, and already behind. That's when the trapdoor opens. So if you remember nothing else from this video, remember this. Being insured and being financially safe are not the same thing. In America, you can do everything right, pay every month, stay covered, and still get wrecked by the fine print. And once you see that, you stop flexing great insurance like it's a personality trait, and you start building a system where insurance is just one layer of protection, not your entire plan. My name is Papa. If this made you see the machine more clearly, hit like, subscribe, and send it to the friend who thinks full coverage means nothing bad can happen. Because the real trap isn't that you're uninsured. The real trap is thinking you're safe just because you're paying.